All right, we are at the top of the hour, so we are going to go ahead and dive right in. We've got an information-packed presentation here for you all. So we're going to try and keep this to an hour. We could go a little bit long, but today we are going to give an update on SmartMix as well as provide our economic outlook. If you are a client on the call here today, I'd like to extend a very special welcome to you. Thank you for taking a little bit of time out of your busy schedule to be with us for this important update. If you are new here, my name is Eric Hagen. I am a small business owner. I am president and senior wealth manager with Capital Consulting Group. CCG consists of myself, Chief Investment Officer Tom Fox, who you will hear from in a little bit later here this morning, financial advisors Dan Oshman and Rana Grant, registered client support Ryan Dewey, as well as Marilyn Westmark. Today, together, we steward long-term relationships with our clients and work only for our clients. Our broker-dealer is Next Financial Group, who is part of the Atria family of companies. We do all of our trading on the InvestNet platform, and we hold all of our client accounts at either Pershing, which is a Bank of New York Mellon company, or TD Ameritrade, who is currently in the process of merging with Schwab. We are an independent firm. We're not owned by a bank, by an insurance company, or some large financial institution. We're located in Eden Prairie, Minnesota, and serve people all over Minnesota. And with our 100% virtual advisor capabilities, we serve people all over the country as well. We can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. To learn more, you can go to clearfinancialfuture.com and watch the 2-minute video. And we can give your life savings the attention it deserves with our SmartMix portfolio solution. SmartMix is our personalized portfolio solution for individual investors. Our agenda today, we're going to look at how SmartMix works. We're going to look at the current holdings in the portfolio. We'll take a look at performance, take a look at some risk metrics. We'll also provide our outlook for the future, both short-term and longer term, and we'll talk about how you can determine your own SmartMix. So what is SmartMix? Well, SmartMix is a process, not a product. SmartMix is our personalized approach for helping our clients get and stay invested right. Everyone is unique. What's right for you is different than what's right for others. If you have an IRA, a Roth IRA, an old 401k, maybe a regular taxable account, perhaps it's jointly owned with your spouse, maybe you have a trust account. SmartMix is our process for helping get each account invested right, given your unique situation, goals, objectives, time horizon, risk tolerance, income, liquidity needs, growth objectives, and more. It's kind of like a blueprint when you're building a new home. SmartMix is a process, a lot like the process everyone uses to build a home. Not all homes look the same, but everyone develops a blueprint first. SmartMix is our process as it relates to investment management. And the same way that there is a blueprint for a young couple just starting out, or a blueprint for a busy family in the thick of life, or a blueprint for a retired couple looking to downsize, there is a SmartMix for many different situations. So whether you are just starting out, you need to grow your savings, or you've been saving for decades and decades and you need to live on your life savings, or you're anywhere in between, there is a SmartMix for many different situations. SmartMix is the next step in the evolution of investing, the same way dial phones replaced rotary phones when they died, and cell phones replaced dial phones when they died, or how CD players replaced cassette tapes when they died, and iPods replaced CDs when they died. Direct indexing, which is what SmartMix is the next step in the evolution of investing. What this means is that we build our clients their own custom SmartMix, and then we directly invest in the underlying stocks and investments for them on their behalf in their own account. SmartMix is how we fulfill what we call a fiduciary obligation, which is a legal term for always putting our clients' best interest first. In plain English, fiduciary means treating our clients the way that we'd want to be treated. So if we were to put ourselves in our clients' shoes, we'd want things like a fee-only type relationship, where how well we do dictates is good for both sides and both sides of the fence, where our compensation is based on how well we do, not what we sell you. We'd want to have our portfolios be transparent. We'd want to know what we own at any given moment. We take what's called a risk managed approach. And this simply means that when the markets go through periods of extended decline, we're going to not sit on our hands. We're going to step in and take action in an attempt to help mitigate those declines. All of our clients are 100% liquid all the time. A lack of liquidity is usually a sign of big commissions. And we don't do any commissions with SmartMix. What we do here is proprietary. So we do the actual work of investing ourselves. And while many people have trusted us with millions and millions of dollars, we do not have any minimums. So there's no barrier there for any of you. So here's how it works. SmartMix consists of our unique investment strategies. Each one of these is its own unique investment process. And we combine these strategies to create one unique SmartMix for each client account based again on their personal situation, goals, objectives, risk tolerance, income needs, time horizon, different types of accounts, amount that you've saved, and more. So what we're going to do is we're going to go through each one of these strategies, and then we're going to look at how we can customize the mix for each different type of account that we are trusted with. So let's dive right in. First strategy that we'll start with is one called our wide moat strategy. Now, the term wide moat figuratively refers to medieval castles. The wider the moat, the more protected that castle. And if you think of investing in a company today, in a stock, as being like a castle, well, what we want are to look for companies that figuratively have a wide economic moat around them. Companies that have a long-term, sustainable competitive advantage. Companies in a good position to protect their ability to be and remain profitable. So that's what we look for here. And this is why our wide moat strategy is a great foundation for many of the accounts that we manage. More specifically, what we want to do is to identify low-cost stocks of companies who have a long-term sustainable competitive advantage when they're gaining momentum relative to their peers. Now, there are over 6,000 stocks traded on the New York Stock Exchange and the NASDAQ. Our process here narrows down those 6,000 to just 25 to 35 individual stocks that we're going to invest in. The goal is long-term growth. Again, these 25 to 35 stocks are a good fit as the foundation of a stock portfolio. So here are the current holdings. You probably recognize most of them. The new additions, and this is as of June 4th, the new additions to the mix include Chevron, Dominion Energy, 3M, Gilead Sciences, and Eli Lilly and Company. But you probably recognize most of the stocks in that list. You see American Express, Bank of New York, Salesforce, Disney, Fastenal, Google, Johnson & Johnson, Lockheed Martin, Microsoft, Nike, Northrop Grumman, ServiceNow, PepsiCo, Regeneron, Schwab, Target. Again, household names, companies that really should show the staying power to be around and competitive for many, many years to come. If we look at the risk metrics of these stocks, we'll talk more about this here in a few minutes, but if we look at the risk metrics, these stocks fall on the risk spectrum at a number of 79, the scale being 1 to 99. What that means is that we have a 95% confidence that over any 6-month period of time, we can expect this mix, these 25 stocks, to be between down 18% and up 25%. There is a nice little dividend coming in off of these stocks at 1.61%. And then if you notice there at the bottom, the expense ratio, because we're actually investing in the individual stocks, there are no hidden or underlying expenses inside of the portfolio that maybe you're not aware of. If we look at performance, there's a number of ways that we can look at this. On the left side of your screen, you're going to see annualized performance. So MRQ, that's most recent quarter on the far left there. That was the first quarter of this year, 2021. Portfolio is up 9.56 relative to the benchmark of 3.6. Over the 1-year trailing, granted that's coming from some of the lows of the pandemic, up almost 40%. 3-year trailing average return of 19.81 versus 8.85. And then if we go out to 5 years, an average annual return of 18.57 versus 10.36. If you want to look at calendar year per year, calendar year returns, look on the right side of your screen. You'll see year to date, that's through May 31st, the most recent month end, up 17% versus 10.74 on the benchmark. 2020 came in at 19% versus 8.28. 2019 up 30% versus 22. 2018 was the last time it was down. That was actually down 4.36 versus the overall benchmark down 13.36%. And then you can see if you look further back, 2017 was pretty much right on at 25%. 2016 up 7 versus 1. 2015 up 3 versus slightly negative. And then 14 was a pretty big difference, up 15 versus down 5. And for any of you that want to look at this closer, if you have questions, you want to kind of dig into the details, hard to see on these slides, happy to connect with you, happy to go through these reports one-on-one. So don't hesitate to reach out after today's message. If we look at kind of a dollar growth value and compare it to the S&P 500, S&P 500 risk number is a 75. So these wide Moat stocks are slightly higher at that 79. So you see that down there at the bottom. If we look over the last 5 years, we can see the growth of both the S&P 500 and these wide Moat stocks. So you can see the S&P 500 rose about 119% over the last 5 years versus these stocks at up 173%. If you look at the two charts and those two lines across the chart there, they look very similar to one another. And so if you watch this on a day-to-day, month-to-month, and sometimes even a quarter basis, these stocks are going to look very similar to the S&P 500. And what we want to see is over longer periods of time outperformance. So slow and steady outperformance over longer periods of time. And that's what we are seeing right here. So that's our wide Moat strategy. Again, this is good as a foundation to the equity side of a portfolio. Next up is our durable dividend strategy. The goal here with our durable dividend strategy is to invest in companies that have shown to sustain and grow their dividends over long periods of time, creating reliable income. This strategy is a good fit for people in retirement who need to live on their life savings. In this strategy, we own 25 individual stocks. And if you think of each of these stocks as being like a fruit tree, what we're looking for are solid trees that produce predictable fruit. The idea here is that we just want to harvest the fruit. We don't want to cut down the tree. So we want to find good quality trees that are producing predictable fruit. If you've ever owned a rental property, owning a dividend paying stock is similar. While the value of that property is important, what is most important is the income that property is generating. So here are the current holdings. Again, this was updated just about a week and a half ago or so. You'll recognize a lot of them on there. And again, all of these companies have gone through a very strict filtering process to find those companies that are paying a steady dividend and growing dividend over time. Now, if we look at the risk characteristics of this, we can see that the dividend rate right now is 2.35%. These stocks as a whole fall into the risk spectrum of a 79. What that gives us is a 95% confidence that over any 6-month period of time, you'll see them down between down about 18% and up just shy of 26%. And again, all individual stocks, so there are no underlying hidden expense ratios to be aware of. Calendar year returns, most recent quarter, was first quarter 2021, up 8.24 versus 3.6. The 1 year trailing up 41 versus 39, so pretty close to the benchmark. 3-year average of 18 versus 8.85. 5-year average of 19.38 versus 10.36. Calendar year returns, kind of give you a second to glance down the right there. And then this chart. So this is showing again the trailing 5-year return. This is a great strategy again for those of you who are in retirement. You need income off of your savings. ROI, which many of you have heard of, or return on investment, is important. But when you're in retirement, a different ROI becomes even more important, and that is the reliability of income, not return on investment. So the value of your portfolio is important, but the amount of income that it generates for you can become even more important. So this chart right here represents the value of the 25 stocks in this strategy, but it does not include the income that they generated all along the way. So that was our durable dividend strategy. Next, let's take a look at our super dividend strategy. This strategy is like the durable dividend strategy, the last one that we looked at, but here we're putting more emphasis on the dividend yield. We want an even larger yield. It's kind of like looking for fruit trees that produce the biggest fruit. Well, fun fact for you, the biggest fruit in the world is something called the jackfruit. Jackfruit is an exotic fruit native to South India. It's part of the family of plants that also include fig, mulberry, and breadfruit. The important thing here is that it can reach up to 80 pounds in weight. And so it can become a very, very big fruit. And again, that's what we're looking for here. We're looking for stocks that have a larger than average income, a larger than average dividend yield. So you recognize a lot of these stocks on here. And if we look at them as a whole, these stocks are producing 5.72% in the form of income just for owning the stocks. They come in on a risk scale at 79. So again, on the scale is 1 to 99, the risk number for these stocks is 79. That means that over any 6-month period of time, we have a 95% confidence that they'll be between down 18% and up 28. But again, producing that 5.72% dividend yield all along the way. And again, they're all individual stocks, so no underlying hidden expense ratio there as well. We look at the performance of these for super dividend. You can see pretty similar to the durable dividend, just a little bit more volatility inside of there. All right, so that is super dividend. Next, we have our thematic strategy. In this strategy, our goal is to participate in the growth of disruptive technologies without the risk of individual stocks. Here's the opportunity. What this chart is showing you is how quickly new technologies are being adopted after they're first released. So if you look way over the bottom left side of the screen there, you'll see that back in the early 1900s, the telephone came out. And when the telephone came out, it reached about a 40% adoption rate by the late 1920s. 4 out of every 10 homes in America had a phone. It actually fell during the Great Depression and then slowly climbed to its peak of about 96% in the 1980s. And the point of this is to show you that when that technology, the telephone, came out, it took decades and decades for it to peak. But if you look over towards the right side of your screen, the yellow, the orange, the red lines, these are the newer technologies. These are the technologies that have been disrupting their respective industries and being adopted very, very quickly. The adoption rate on things like cell phones, internet, digital cameras, MP3 players, HD TV, social media, smartphones, and tablets. The adoption rate of these technologies has been virtually straight up. Thematic investing gives us the opportunity to participate in the growth of these new technologies without the risk of individual stocks. So instead of investing in individual companies in these areas, because of investment developments, we can invest in the actual theme itself by using something called an exchange traded fund, or ETF, that represents the particular theme that we are interested in. So currently, these are the different themes that we're in. This is up to date as of early June here. Did make some changes a couple months back, but we're in a genomic revolution. That's a genomic medicine ETF. We're in the ARC Innovation Fund. That's a little bit more broad ETF. We're in robotics and artificial intelligence. We're in one called Smart Mobility. That's essentially anything you can do with your smartphone. And then we're in some specific areas of the market. So mid-cap value, small cap value, and then we're in lithium and batteries. So that's kind of a play on the electric movement. And then we're in one called Moonshot Innovators, innovators who are literally shooting for the moon. So on the risk spectrum, it is a much more volatile portfolio. It comes in at a risk number of 93. That means that we have a 95% confidence over any 6-month period of time will be between down 32% and up almost 42%. Very low dividend rate of 0.85%, and we are in lower cost ETFs, but they do have an underlying expense ratio here at about 0.45%. Can't go back as far as some of those older strategies, the other strategies that we have, but here we're looking at June 1st of 2020, so pre-pandemic, through the pandemic, and then through June 1st, just a couple weeks ago here. S&P 500 risk number 75. Again, this risk number here is a 93. And you can see S&P 500 up over that time at 32%. This thematic strategy, those holdings today up almost 92% over that same time period. So again, that was our thematic strategy. Next up is our pandemic recovery strategy. This is a unique strategy because it's timely and came as a result of a unique event, the COVID-19 pandemic. It's kind of like when you get injured, right? So when you get injured, you take steps to try to fix the injury. You put bandages on, you medicine, you medicate, you do different things to try to heal that injury. Doesn't mean that the injury is guaranteed to heal, but that's the expectation. And the same thing can be said about the stock market. It's just that certain areas have not yet recovered. So this strategy looks to those areas in the market that have not yet recovered the way that other areas have. The expectation is that there are areas that have not yet recovered, but should. So here we see the overall market as represented by the S&P 500 dating back to before the pandemic downturn in the spring of 2020. Now, many people I talk to believe that the entire market has recovered. And while you could say that, it's not the whole truth. So here a second. Okay. So if we look deeper at all the different sectors or categories of the market during that same time period, you can see that some areas have recovered much better than others. So some areas are up, 53%, while other areas still down 17%. So again, what we're doing with this pandemic recovery strategy is looking for opportunities to participate in the recovery of certain stocks that have yet to do so. So here are the current holdings in our CCG pandemic recovery portfolio. You'll see an emphasis on real estate, energy. There's some financials in there. There's some travel stocks in there. So those of us here recognize a number of those inside of there. So again, a much more risky portfolio. The risk spectrum, this comes in at a 93. Volatility of between down 31% and up 40% over any 6-month period of time. Does have a decent dividend yield to it of 2.39%. And again, all individual stocks, so no underlying expense ratio to consider there. This is kind of neat. So if we go back to January 1st of 2020 through June 1st of this year, a couple weeks ago, we can see S&P 500 up 32%. So what you should expect with this pandemic recovery portfolio is that it has not fully recovered. It's not done as well as the overall market. And that's what we see. So over that same time period, only up 3.8%. Now, if we look at more recently here, so this is year to date through June 1st, we can see S&P 500 up 14% and the pandemic recovery portfolio up 42%. So closing the gap, and the expectation is that that is going to continue, and we'll continue to see outperformance relative to the S&P 500 as we move forward. All right, so that was the pandemic recovery portfolio. Now let's take a look at our tactical ETF portfolio. And this portfolio, and actually there's two components to it, so I'll go into each one, but this portfolio is a lot like a swing. And what I mean by that is that areas of the market, sectors, styles, they swing back and forth in and out of favor. And so what we want to do here is we want to make changes to the portfolio as different areas of the market swing back and forth in and out of favor. So sometimes growth type stocks are in favor, and sometimes value type stocks are in favor. So here what we're looking at is a time period from April of 2020, kind of the lows of the pandemic, to the end of 2020. So about 6 months ago. The blue line is the overall market, the S&P 500. And during that time period, it gained about 30%. But the green line is just the growth stocks in the S&P 500. These were up over 35%. But the gold line are the value type stocks, and they were only up 19%. So during that time period, growth stocks far outperformed value stocks. Growth stocks were in favor and value stocks were not. But here, if we change the time period to just the past few months, the overall market, the S&P 500, the blue line, it's up about 8%. But the green line is only up 5.4%. The green line, again, is those growth type stocks in the S&P 500. Whereas the gold line, those value type stocks, they are up 11.2%. So over the past few months, value stocks have outperformed growth type stocks by more than double. So you can see that value and growth, they go back and forth in and out of favor. And then the same thing can be said with different sectors. So this is the periodic table of investment performance by sector. And what you're looking at here are calendar year returns for each of the different sectors of the stock market, dating back to 2007 through last year, 2020. So you can see across the top there, those were the winners. Those were the best performing sectors. So take last year, 2020, information technology was the winner, up 43.9%. Then right below it was consumer discretionary, up 33.3%, and then so on down the way. 2019, information technology was also the winner, up 50%. But in 2018, healthcare was the winner, and it was up 6.5%. So this is a relativity type chart showing which sectors are winning and which sectors were out of favor. And so what we do with this strategy is that we want to make changes to focus on those areas, both style and sector, that are in favor while avoiding those areas that are out of favor. So right now on the style side, we're in S&P 500 value, we're in mid-cap value, we're in small cap value, and then we're also in this S&P 500 equal weight index. From a sector weighting standpoint, we're in technology, energy, communication services, and real estate, and then we've also got some S&P 500 equal weight in there. Now, this portfolio can change a lot. It can change more often. It's not predictable, but as we monitor the markets and as things come in and out of favor, we'll make changes to that portfolio in an attempt to keep up with those changes. On the risk spectrum, the style side comes in at an 87, fluctuating between down 22 and up 29%. A little bit of a dividend yield there, very low expense ratio. And then on the sector side comes in at an 82, down 19% to up 27%. Again, that's over a 6-month period of time. Slight dividend yield there as well. And then a small expense ratio for those underlying funds. Okay, so that was the tactical ETF portfolio. Last on the stock market side is our aggressive portfolio. And this approach is kind of like a baseball player swinging for the fences, right? They step up there, they're swinging to hit a home run. When they do that, they may miss a lot of singles and doubles, but sometimes they'll connect and hit it out of the ballpark. So in this strategy, we invest in individual stocks in themes that we feel are promising, stocks that we believe have the opportunity for explosive growth. So it's similar to our thematic strategy, but here we are taking on the risk of individual stocks. Now, this is a newer strategy starting for us earlier this year. Jump ahead here. So these are the current holdings in this strategy. You probably heard of ones like Airbnb and Fisker, but some of these other ones you may not have heard of before. And there are no guarantees, but our expectation here is that each one of these has the potential to deliver 300% to 500% returns over the next 3 to 5 years. Of course, this is a very aggressive strategy. It moves up and down in large swings in short periods of time. It's not a good fit for many people. Those that do go into it, we usually put a relatively small portion, like 10% of a portfolio, of your overall portfolio, into this mix. On the risk scale, it comes in at a 97. This means that the expected range of returns over any 6-month period of time is down 39 to up 51%. There's no dividend yield on these, and of course, there's no underlying expense ratio. Compared to the S&P 500, year to date, S&P up 14%. These stocks are up about 3.5%. Earlier on in the year, they were up roughly 70% or so. They've come down. We're starting to see support. Our expectation is that this is going to look good through the end of the year, but there are no guarantees with investing, of course. So again, that is our most aggressive strategy. Some of these stocks could go down and never come back up. Some may hit it out of the ballpark. It is not a right fit for everyone. So what we've talked about so far are all of our stock market strategies. And what I've just described is our process for what to own and when to change. One last thing that I'll add is that with all the accounts that we manage, we take on full discretion. What that means is that we can make changes to our clients' accounts automatically for them while they're busy, with family, with life, with work, whatever it may be. Now that includes the option to reduce exposure to stocks in the stock market altogether. There are periods in the market when it just doesn't make sense to stay invested. This means that sometimes we may reduce exposure to the market. 2020 was the most recent example of this. We reduced exposure to the market when the pandemic first came to America, and then we got back into the market near the lows and over the rest of the summer. Today, we are fully invested in all strategies, which is kind of a reminder on what that full discretion means there. Okay, so now lastly, many people should not have their entire life savings in the stock market, at least in the traditional sense, to begin with. So what we have is our fixed alternative strategy that we use to balance things out. This strategy is for those accounts that we manage that should not be fully invested in the stock market. This strategy brings balance to an overall asset allocation plan, to an overall portfolio. Traditionally, as we age and get closer to when we need the money that we've saved, we would shift our investments out of the stock market and into the bond market. But right now, we're in an environment that creates problems for owning bonds. Number one, rates are low. Rates on bonds are low. Bonds simply aren't paying much in the form of yield. And this trend has been coming down for decades, really. You can see that on the chart there. Two, the value of bonds have an inverse relationship to interest rates. When rates go up, the value of bonds go down. So interest rates today are very, very low, and they can only really go up. And when they do, this is going to put pressure on the value of bonds, right? So instead of owning individual bonds, we're about 70% out of bonds and in non-traditional strategies. All of these strategies have the risk characteristics of the bond market, so they're much safer than a traditional approach to the stock market, but they don't have the interest rate risk that bonds carry today. Looking at those risk metrics and the expected fluctuations in value, we can see that these holdings come in at a risk number of just 28. That means that over any 6-month period of time, we can expect the portfolio to be between down 3.6% or up 7%. It does have a dividend yield of about 2.2% and an underlying expense ratio, because these are all funds that we're using, at 0.86%, but much, much more conservative portfolio. If we look back over the last 10 years, we can see a slight outperformance over the traditional bond market. The bond market comes in at a risk number of 24. This mix comes in at a 28, so very similar again from a risk perspective. But when we look at an environment where we're starting to see interest rates coming up, trouble for bonds, if we look back over the last 1 year trailing return, that bond market is actually down. So if we're using the iShares Core US Aggregate Bond ETF to represent the entire US bond market, it's actually negative 0.7%. But our alternative mix that incorporates some of these alternatives is actually up 9.2%. And so we do think that that trend is going to continue. I'll let Tom weigh in more on that later here, but this strategy is working very, very well. Okay, so again, that's why we call it our fixed / alternative strategy. Sometimes we're in bonds, sometimes we're in alternatives, oftentimes we're in both. The mix between the two is based on the environment that we find ourselves in. So those are the strategies. Those are the strategies that make up SmartMix. We have accounts that we manage that consist of one of these strategies. We have accounts that we manage that consist of several of these strategies. The thing that makes SmartMix smart is that we will mix these strategies unique for every single account that we are managing. Everybody's different. Your mix is based on your unique situation, your goals, your objectives, your risk tolerance, your income needs, your time horizon, and more. And that's something that we can help you with and that we can help you monitor over time. The longer your time horizon, the longer until you need the money, the higher the risk you can afford to take. Doesn't mean you have to take it, but the higher the risk you can afford to take and the more growth you therefore should expect. So maybe you're more of a mix like over to the left side of your screen. The shorter your time horizon, the sooner until you need the money, the lower the risk you can afford to take and the less growth you should expect. If this sounds like you, well, then your mix may be more over towards the right side of the screen. And you may have different allocations that are right for different accounts. If most of your money is in an IRA, you may have one allocation mix for that account. But if you also have a Roth IRA that maybe you're not planning on touching for a while, or that you want to just leave to your kids tax-free, you may be more weighted towards growth in that account. So for all of you listening here today, whether you're an existing client or you're new here, ultimately the question that you should be asking is what is your smart mix? What is your unique smart mix? Now, it used to be that we'd use terms like conservative, moderate, or aggressive. And using these terms is a lot like saying that you set the cruise control in your car at slow, medium, or fast, or that you set the temperature in your home at cold, warm, or hot. Well, we use specific numbers for all sorts of things, like the cruise control speed or the temperature in our homes, all of which are far less important than how we invest our life savings. So we want to get the same kind of precision when it comes to our investment portfolio in our financial future. So what we do differently is to start with something called a risk number. You saw this number used with all the different strategies that I showed you. It's a technology that's built on a Nobel Prize winning framework. What it allows us to do is to have you answer a few questions to determine your unique number, and then we're able to build a mix using our strategies in a way to match. For instance, let's say that you answered the questionnaire, you scored a 45. Well, we can put together a portfolio using our different strategies to match that 45, to meet your expectations. Let's say you're 65 years old, you're ready to retire, you've saved $1 million. We can engineer a custom investment portfolio using our strategies and show you that over any 6-month short period of time, that portfolio will be between down 8% or up 13%. And we can do so with a confidence of 95%. So again, step 1 is to determine your risk number. Step 2 is for us to put together your unique SmartMix. In a few minutes, if you already have your accounts in SmartMix with us, I'm going to show you how you can check your mix. And for those of you who have accounts that are not in SmartMix, I'm going to show you how you can see what your unique SmartMix would look like. But before we get to that, I'm going to turn over the call to our Chief Investment Officer, Tom Fox, and he's going to give us his economic outlook. And then I'm going to come back on here and show you how to determine your SmartMix and how to check it as well. Here we go. All right, so Tom has over 30 years in the investment business. He's an expert in building quantitative investment approaches. He's the architect, the creator of numerous successful academically based investment strategies. He's managed over $1.5 billion at a previous firm that he was owner in and with. He presented proprietary research to the Federal Reserve Board's Investment Committee. He's got quite the resume. I'm always very pleased to have him here with us. Tom's going to talk about the positives in the markets and the economy. He's going to talk about potential headwinds, and then he's going to give us his outlook for the rest of this year and beyond. As you're listening to Tom, please feel free to ask any questions that you have using that chat box. I will be paying attention and watching that, and then I'll present them to Tom at the end of his message here with us today. So with that, I'll turn it over to you, Tom. Tom, are you on the call here?
I believe so. Can you hear me?
You are indeed.
All right. Good morning.
Thanks for being here.
I think it's still morning. It's almost noon, everybody. Today's a unique day because the whole market, investors across the world, are looking to the Federal Open Market Committee today because in just a few hours, they're going to announce a decision on what they're going to do with interest rates and the recent inflation numbers that we have had. And so I'd love to give this talk tomorrow, but I'm doing it in advance. So we'll see how prophetic I am as we go through this. But some of the assumptions we're making today could be changed depending upon what happens in just a few hours. So at about 1 o'clock, they'll be announcing what they're going to do. And at 1:30 today, Federal Chairman Powell's coming on, and he's going to describe what they printed out at 1 o'clock. So I'm looking forward to that. I wish we having this just right after, so I make sure that all of our outlook is intact, but I believe it will be. So we'll go through it based on what we know today. Today, the U.S. economy is gaining strength, and the data is coming in, and we think it's going to surprise to the upside as we even go forward. The economy is getting stronger and stronger. There are some weak points. There's some areas of the economy that haven't healed yet, but they'll begin to heal, we believe, very soon. So we think there's a lot of upside to the U.S. economy. Fed chairman again is meeting today, but he just last week there was a boost in his outlook of transitory inflation. What's transitory inflation? That's inflation that's just here now as we're coming out of a deep recession, but it will moderate as things normalize, and that it's not here to stay for the longer term. And we saw a hotter than expected CPI number, yet we saw the Fed I mean, the interest rates even drop a little bit, and we saw the markets go up. So what does that mean? It means that more and more investors are starting to buy into the Fed's outlook of transitory inflation. Of course, there's many on the other side that believe they're behind the curve and they need to start raising rates. But we'll see what happens today at 1 p.m. So the Fed, we believe the Fed has mostly hold off in tapering at today's policy meeting. This is very positive for the market. Another great positive is how much money is on the sidelines. Institutions over the last several months have raised a lot of cash. Now I think they're looking at inflation. They looked at the rising interest rates, but now rates have come back down, and the 10-year Treasury has fallen from 1.75 to below 1.5, and right today it's below 1.5 at 1.47 or something like that. So that is a positive sign for equities and for investing. Another major positive sign is COVID-19 cases, the new cases, hospitalizations, deaths, positivity rate is all trending in a positive way. So all those numbers have come down significantly, and which is, you can give tribute to our amazing medical technology of the vaccinations that came so quickly. So we'll talk about that. But all these are positives, and why we think it's a good time to be in stocks, even after a great run up like we've had since the bottom last year. All right, there are potential headwinds. And this is if the Fed's view of inflation, this is a big one, of being transitory ends up being wrong. This will set off a taper tantrum. They're going to have to raise rates faster than expected. This would be bring the equity markets into at least a correction, possibly a bear market. We think this likelihood of this is low to this point, but that is a potential headwind. The other resulting from that would be a 10-year Treasury yields move above 2%. Most economists that I read about are believing that the 10-year Treasury yield will be about 1.9% by the year end. We think it's going to remain below 1.7. You'll see that later on. But that if it goes above 2%, that would be negative, because that would bring on more competition for stocks, because now you can get a higher, safer yield than the stocks at this time. The other thing is we've had robust earnings and revenues surprise last quarter. Well, they've all adjusted their earnings outlook. And what will happen in the second quarter coming up in July? What happens if corporate earnings do not surprise to the upside? And so we had massive surprise in the first quarter, but if we just come at or just meet the current earnings outlook, then I believe that could be pull the market down a little bit. Now here's the wild card. The Delta variant, which came from India of COVID, it appears that it's overcoming some of the vaccinations. And if it would come to the US in a big way, this could cause an issue. This particular variant spreads a lot easier. It seems to beat some of the vaccinations. I think Moderna and Pfizer are holding up fairly well against it. But if in some of the other areas of the world, we're seeing this Delta variant rip across, especially India, where it came from, and so on. So this is a wild card. So we want to keep an eye on the Delta variant, because that could cause potentially we go in reverse rather than opening. We may have to start closing again, but I'm hoping this does not occur. All right, so what is our outlook for the second half of this year? We believe that the market's the S&P, the markets, equity markets are going to continue to go higher, but it's going to be a bumpy road. We don't believe that it's going to be a smooth road. They're going to be kind of ebbs and flows, but we do believe that the markets are going to head higher from here. In fact, our S&P 500 outlook is that we reach 4,400 by the end of July and 4,700 by the year end. So this would mean that we are going to continue to have a bull market the rest of this year, although it will be bumpy. And we believe our forecast is that the Fed's going to hold tight on tapering until 2022. Remember, they said they're going to hold tight until 23. We do believe they're going to move that up to 2022, but we're keeping our eyes on, and today at 1 o'clock, we're going to learn a lot more about that. Inflation proves, we believe that inflation will prove to be transitory as supply chains catch up. So there's been a shortage in semiconductors and chips, which has hindered some of the manufacturing of the automobiles, which is one of the reasons that car prices are rising very fast. And so are used cars. They're up huge in terms of percentage. So we've seen also in the housing market, because of the very low interest rates we have to get a mortgage today, we've seen a high demand to buy homes, which has caused home prices to rise. And as a result, we've seen lumber go up dramatically this year. But now the lumber, which is really, I'm excited about this, lumber has topped out. It's come down 40% from its recent high, but it's still up over 200% for the year. So we're expecting lumber prices and some of the commodity prices, except for energy, oil, I think that's going to stay very high. But some of the other commodities, I think, will begin to moderate and maybe even come down. Now, also in our outlook, we have Eric talked about our thematic stocks. This would include the aggressive growth. They were leading the S&P by a lot going into February. Then about halfway through February, both the thematic and the aggressive growth came down sharply. And so we saw on May 13th what we believe is a recovery of this recent short-term decline. Now, we're excited about the thematic stocks. Nothing in the themes that we're buying into have changed, but it was just that investors went on pause, but we think now they're going to start buying these up again. And so we're expecting good numbers by the end of the year for the thematic, and you would say the aggressive growth, the Babe Ruth home run hitters. All right, so growth stocks underperforming this year. They've been outperforming value for almost 10 years, and now they were outperforming values shifted, and Eric showed a chart on that. And they're winning this year, but we think there's going to be a short-term surge back. There'll be temporary back to growth, where that will catch up a little bit on value stocks, but we do believe by the end of the year, value stocks will hold their lead. That when we believe will probably win the fourth quarter and also the year. And also, this is probably outside the mainstream, but we're thinking that the 10-year Treasury yields will remain at 1.7, which was the more recent high, or below. So we're expecting that to be remain low, which would be great for the stock market. All right, now this is the counterbalance to some of the inflation numbers we've had recently, and that is employment, because the employment numbers have been weaker than expected. And you can see here, this is a different way to look at employment. It's the payroll growth, monthly payroll growth, and total employment relative to pre-pandemic. But you can see it's still 5% below where it was before the pandemic started. So there is still a lot of healing that needs to take place in our employment area. In fact, there's 7.5 million jobs still below what we were before the pandemic hit. So there's 7.5 million people still out of jobs that had jobs prior to the pandemic. Now, this is the slowdown in the expectation for earnings growth. And you can know we knew we had a record high again in the first quarter. We beat there were many beats in revenue, many beats in, record beats in revenues and earnings. And so, but what you can see at the bottom of these dates, you can see it goes from 5/1, May 1st, 2020, down to the bottom, June 4th. So this is pretty current. And what it shows is that the last three numbers from June, 6/1, 6/3, and 6/4, are starting to moderate or even go down. So what you can see how they all climbed. The expectation for the second quarter, third quarter, and fourth quarters is the ones we want to focus on. But there's going to have a biggest blowout in earnings and revenue will come in the second quarter, and then it will go down in the third quarter, and then begin to moderate even more in the fourth quarter. But you can see the analysts, the earnings analysts, are not raising earnings anymore. So we're going to see how that comes in. If there's some disappointment in the July in the earnings and revenue numbers, then you could see this market pull back, but we believe it's going to stay strong. Here's the Treasury yield. This is, I think Eric in one of the previous slides showed the long-term Treasury yield, but now you can see from the peak of 1.75, it is trending down. In fact, it's below 1.5% today. What this is telling us that more and more believers that we are in a transitory inflation situation based on the supply chains and the high demand coming out of the pandemic and the recession. So we're expecting this to happen, and we believe there will be a trading range between 1.4 and 1.75 throughout the rest of this year. This is all good for stocks, but it is heading downward. Okay, we talked about gunpowder, plenty of cash that's on the sidelines. And these two charts just show how much this year that that institutions have been raising money. And you can see that it's splurged. It's up over $407 billion have been added to cash. That cash has got to go to work because these institutional investors will need to put this to work somewhere. And if they begin to feel that the stock market is still a good place to go, you're going to see a lot of this money go into stocks, which again will be good for the stock market. Now, this is an interesting chart because it shows you what the net equity issuance, that means how much new equity capitalization and equity shares have been introduced to the stock market versus companies are buying back their stock, their shares. So how many new shares are being issued? How many shares are being bought back by the companies? And you can see that the number of buybacks is trumping the new issuance. So the new issuance are way down, the buybacks, the companies. So what's that mean? There's less stock supply. If you look at the total stock market, there's not as much stock out there as there used to be. In the old economics 101, supply demand, if the supply is lower and the demand's still high, stock prices go up. It's good for stock prices. It's not a major factor, but we just took note of this, another positive for the stock market. Okay, this is the value growth comparison. This is the PE ratio for the value stocks relative to growth stocks. And if you can see the average of 0.73, that means that on a historical basis, that's the normal place that the difference between growth and value PE ratios. But you can see the line is still one standard deviation below its average. What does that mean? That means value is still very cheap relative to growth. So everything goes, everything migrates back to the mean. So we're expecting this to go back up to the average, which what does that mean? It means that value stocks have a lot more room to run than growth stocks from here. Now, we get a lot of questions about Bitcoin and digital assets. And so we took a look at how does cryptocurrency, gold, and equity returns, how do they compare on each downturn in the market, the stock market. And so there are 12 occurrences here. And it's hard probably for you to see, but the dark blue bar is stocks, and the gold colored bar is gold, what gold did whenever there's a downturn. So there's 12 downturns that is measured here. And then you can see the red and the lighter blue, that is Bitcoin is red, and the lighter blue is other digital assets. And what it shows is that when the stock market goes down, that you can find that cryptocurrency will even fall much further. And when many people, investors, are saying, hey, I want to get a diversification into digital assets or Bitcoin, well, you may not be getting the diversification you're looking for, because when stocks are down, you're looking for something that may be up or flat. That's not true most of the time for digital assets like Bitcoin, and that can even be down even more. Now, there was 7 out of 12 times that the cryptocurrency did a little better than the stock market, but the other 5 times it was under. Now, how does that compare to gold? Gold was up 11 out of the 12 downturns above the market. And in this case, it's the global market, equity market. So what is it saying? Gold may be a better diversifier than cryptocurrency. Now, for astute investors, I think maybe owning a small percentage in cryptocurrency, Ethereum or Bitcoin, would be a good idea, but just a very small percentage. And you will get some diversification, but don't expect it to do well when the stock market goes down. Here's the other thing about Bitcoin and digital assets. You can see Bitcoin here. You can see that the volatility is tremendously high. We've noticed it runs high, comes back down, runs back up, comes back down hard. It fell over about 36% from its high this year already, and that's beginning to make some of that back. But you can see the stock market and gold are very similar in volatility, but look at how high digital assets and Bitcoin are. Now, this is a longer term chart. Bitcoin wasn't around that long, so this is a trailing number. So you can see that the volatility is much higher than gold. So we would say, okay, if you want a buffer, probably gold is a little bit better than digital assets, but I maybe own both, a small percentage. Okay, the G7 just met, and this is what their outlook for. Electric cars are going to overtake the combustion by 2035. That's what the expectation is. And you can see they're out to 2040 that it's pretty much hybrid or fuel cell, a little bit of that, or it's going to be electric, which will dominate. So this is in our thematic theme. That's why we have a number of focusing in on the electric car benefits that are coming. But you're going to see, I would say very soon, you're going to all be driving electric cars. And so then it's going to be an amazing transition. It'll be good for the air we breathe. And so I'm looking forward to this. But you can see how powerful this thematic trend is. And that's why we've positioned ourselves in the electric car area. Okay, let's talk about COVID-19. This is good news. You can see the daily cases, and then the blue line is the rolling 7-day. And this is the more recent numbers. You can see the red lines, the red bars going below. That means the daily cases are falling. Now, we had a little distortion on Memorial Day because the numbers weren't put out, but then it went right back down to being negative again. This is great. The COVID numbers in the United States are coming down very fast. Now, the weekly vaccinations have slowed from a peak of about 4 million to over 1.2 million currently. So we're still giving out vaccinations. And what's really of a positive fact is that all states today, all of our states in the US have a combined penetration of what we call a combined penetration is how many of the population have had vaccines or the infections. So that we're moving very rapidly towards herd immunity. And so 70% of the states have now reached this level of protection, vaccine, and or had the infections, which means they have antibodies. Very exciting. Now, I'm thinking about moving to California because now they're offering huge money to get a vaccination. They're trying to get some of the younger people and people who have avoided it to get vaccines. So they've decided to give 116 million people dollars to people who get virus shots. So I think you can see me somewhere in that line. I think this is great, but this is to get the ones that are holding off to give them some incentive. That's pretty rich. I don't know how much each one gets, but 116 million is a lot of money. So we'll see about that. Here's a really good chart. It shows the net hospitalizations and the mortality or deaths from COVID. And you can see both are at all-time lows. This is heading in the right direction. Hopefully the new variant doesn't get here, the Delta variant, in a big way, but this is going in the right direction. That's why you're seeing reopenings. That's why you see people in sports stadiums. So this is very exciting news. Now, this is just the other side here, because there is what's called breakthrough COVID variants we just talked about. And the Royal Caribbean cruise, they had to put everybody in quarantine on the cruise because 2 people ended up testing positive for COVID, even though they'd been vaccinated. And now we're not sure if that vaccination was an honor system or they were actually tested. It showed their test, but when they got on the ship, supposedly they tested negative, but when they were on the ship, they kept testing, and 2 of the people in the ship ended up being positive. Now, I wouldn't want to be on that ship where you're sitting in a small stateroom for the entire trip. Wouldn't be a lot of fun. This is the scary one, is Calgary Hospital had 22 cases linked to Delta COVID variant, and 10 were fully vaccinated. Now, I don't think they had Pfizer or Moderna. They maybe had a different one. But, and again, I think Pfizer and Moderna is doing really well. I think it's in the high 80s, its efficacy, but still we're watching this very closely and just pray that this does not head to the US. Okay, so let's talk about some of the portfolios. I know we've been, you're probably ready to take a nap after all this. Eric was pretty long-winded, so I'm trying to make this a little shorter. But performance and the wide moat has now surpassed the S&P. Thematic, again, underperformed, which we talked about since mid-February, is on May 13 turnaround. Again, we expected to edge out the S&P. Our durable dividend has been really lagging the wide moat, but we expect that there will be eventually a shift to the dividend stocks sometime this year or next year. And then aggressive growth, similar to Thematic. It's more of a Babe Ruth home run individual stock portfolio, but it did the same thing, underperformed since mid-Feb, but it's been up a lot since May 13th. And so that could be a big winner. And again, in that portfolio in 3 to 5 years, we're looking at maybe 5 times to 10 times if we get a lot of big winners in it. But it's a home run hitter type, very risky. but we think it's in the right themes going forward. A lot of electric car themes are in that portfolio. All right, SmartMix. Again, we're tilted towards alternatives. Almost all of our, even the bonds we own in this portfolio are, they're not your usual bond structure where they're just going long bonds, but they can go short, they can do other things. So we have done very well relative this year, and Eric showed the chart on that. We saw that interest rates were going to probably bottom out and start coming up, and we were right on that when we made the shift out of bonds. We may go back in bonds down the road if the rates get high enough. But right now we're in alternatives, definitely more in alternatives. And we're hoping for returns around the 3 to 5% by year end. I think it's up about 1.5% year to date. So we're looking forward to that. And then SmartMix recovery portfolio. This is that one that's, he showed that the nurse or the healing Band-Aid. This is the stocks that really got hurt during the pandemic that if they heal, they have the potential for very high returns. And this portfolio will not be around forever. It's sort of a shorter term in terms of duration. It may disappear down the road once these stocks recover, because then the recovery won't be needed. But we'll see what we'll do with this. But right now, we still think it's a great place to be. Okay, we've added new portfolios. We got, Eric has talked about these, the super dividend. This is a new one. We're targeting over 5% dividend yield. And you would take that, now these stocks are more risky than the durable dividend. The durable dividend, which is we're focusing around 2.5 or a little less. This one we're targeting 5+ on the dividend yield. And of course, when you buy stocks with a higher dividend, there is going to be more risk. So this has, even though the risk chart was similar, this portfolio has more risk than the durable dividend, because those are the real high quality companies. These are less quality, but we think it's a great time to be in super dividend for now. Now, we also added the tactical style, tactical sector, and these are, again, rotating among styles and sizes and shifting among sectors. And we're either will buy the cap weighted S&P 500 or move into the equal weight, depending on the trends that are going on. This is a more active portfolio. We'll be making trades probably every month. And but the objective of this is to outperform the S&P 500. So these are our 3 new portfolios. We're very excited about these 3 added to the others. So we have a fantastic menu of SmartMix portfolios, and Eric and his team can really help you design a portfolio with mix and match and mix the portfolios that are for your particular situation. So we're very excited about these offerings. So yeah, what is your SmartMix?
Yeah, that's exactly right.
I didn't know that was coming. I was already moving ahead of you, Eric.
I love it. Take over. You're doing a great job. Really appreciate you, Tom. You're always such a wealth of information, and as I've said before, just being able to cut through all the headlines and all the hype and all the fear that seems to be prevalent in 24-hour news cycles and things like that. It's just you're a real blessing to be able to cut through all of that. So thank you for all of your work here today and what you shared with us. So for everybody listening today, whether you're an existing client or you're new here, as Tom said, the next question is, what is your SmartMix? It is unique to you. It is unique to your particular situation. If you are an existing client, you have money, you have accounts in our SmartMix portfolios, and you want to check your allocations, what I want you to do is to shoot me an email and just say, I'd like to check my allocations. What I'll do is I'll reply with a unique link for you to go and go through that risk number questionnaire again, like you've done before. And then that unique will be unique to you, and that will compare the current mix to the risk number, and we'll see if we need to make any changes there. If you're new here and you'd like to see exactly how we would put our strategies together for you, well, then what I invite you to do is to go, after we're done here, go to www.getinvestedright.com. CCG.com. Being invested right is unique to you, right? Is subjective, right? And then you can try out that risk number questionnaire there. When you're done, the results will be sent back directly to me, and I'll be able to send you an email with your SmartMix portfolio for your review and consideration. And then we can set up a time to talk if you'd like to do that, of course, as well. And then, of course, for anybody on the call, if you'd like to go through this together, we can hop on a Zoom call like this, go through the questionnaire, we can get together at my office, whatever is most convenient for you. Happy to do that and accommodate you as best as possible. So that brings us to the end of our SmartMix update and economic outlook for this month, June of 2021. With that, I'll open up to any questions. I'm looking at the chat box and the Q&A box. I don't see any in here right now, Tom. But we'll give it another few seconds here. If anybody has a question, go ahead and submit those in either one. I've got both of them open here. Otherwise, we will try to keep it to an hour. I knew it would go a little bit long. So thank you for your patience, everybody. Thank you for sticking around with us. I don't see anything else coming in here, Tom. Tom, anything else you want to add before I close this down today?
No, but check your financial news at 1 p.m.
Yes, yeah.
This more. So all that we've said may change depending on what the Fed does, but we think they're going to hold.
Absolutely, and then we'll be doing another update sometime in July. We try to do these monthly, so you can look forward to those as well, and we'll be able to address that. So I don't see any questions, any comments. If I missed them, I'm sorry. We'll follow up with you if I'm not looking at the right spot. But I've got the Q&A box and the chat box open. I don't see anything, Tom. So with that, just a reminder: I do go live every Monday. Do a short 3 to 5 minute video talking about the economy, things that we're watching, things that are coming up. Sometimes review the performance more briefly there. It is a much shorter presentation there. After years of pre-recording the video, I do it live now, so you can join on Facebook, on YouTube. If you're not connected with me there, go follow, subscribe, turn on the notifications. And then after I'm done, I do send out an email with a link to the recording. So if you're not getting that email, be sure to go to our website and subscribe via email there as well. The email has more than just the video. So something that you definitely want to subscribe to so that you're getting that. You can find links to everything associated with that Monday update at our website /WEVU. So go to investwithccg.com/WEVU. That's weekly economic video update. And you can just put in your name and email right there and you'll be getting everything. So with that, I will go ahead and close down the call today. Thank you everyone for joining us. If you're watching in the recording, thank you for spending the last hour and 12 minutes or so here with us today. And we'll look forward to chatting with each of you again soon. So thank you again, everybody. And Tom, thank you very much as well.
You're welcome. Thanks, Eric.